Welcome to, let's start again, shall we? 1 second. Welcome to this edition of Expert Market Analysis, brought to you by Errante. This is generally a bi-weekly preview and review, so every other week, of the markets and key events and trading opportunities that we see. So I just let you have a look at the disclaimers, which there are two. I'll just run through some of the key objectives and objectives, of this webinar. We think markets are generally driven by themes which buyers can relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase and decrease in importance over time. So with that in mind, we'll just run through what we hope to get through in the next 30 to 40 minutes. We'll follow the usual format, which for most of you, you'll be familiar with. So that is essentially looking at how markets are shaping up currently. We'll then just concentrate on a theme, which we mentioned in our intro, actually, about financial conditions and the Fed and this pricing, this very severe pricing of rate cuts that we've seen recently, and how that is affecting certain assets, especially gold, with this everything rally that we have been seeing over the last few months. So gold has been rallying, bonds have been rallying, and stocks as well. So we'll look at gold specifically and stocks, and also some of the seasonals around some of these risky markets and what that means going forward for the next few weeks. We'll then, just check out some of the recent data, which has been important. The Eurozone inflation data, really important for the euro dollar, in fact. And then some of the central bank meetings that we have had, so the RBNZ, the RBA this week as well. Before then looking at this week's main events, the non-farm payroll report, of course, and also we have a Bank of Canada meeting out later today. First up though, we just want to show you this chart, which is something really interesting for us. Before we just get to that chart, we'll just check out that markets. Let's dive into this chart actually, because markets currently quite relatively okay. Futures are up. US futures are up after a mixed session in Asia, essentially. We had sort of mixed data out of the US yesterday, which we'll briefly get to later on. Downside surprise in the jobs, JOLTS vacancies opening, that is, and then an upside surprise in ISM services. So sort of mixed reaction, but bond yields fell further actually, and away now down below 4.2% for that crucial 10-year US Treasury yield. Just focusing on gold first of all. Yes, that's trading, just checking that actually, sorry, that's trading just marginally higher on the day today after obviously hitting all-time highs in the early hours, really, of Monday trading in Asia. Really interesting price action there with that massive spike up to sort of 21.48, that all-time high, as I say. Before then, a sharp tumble down over 6% now. We're away from that all-time high. And interesting that, some of the factors surrounding that sort of bullish move, initial bullish move actually, that we have seen around rates, around the falling dollar, geopolitical risks, of course, with the war in Gaza, Israel, and then also underpinning that central bank buying and demand for gold longer term. So a lot of those factors, those four factors we're looking at for gold, and some of those are turning around and slightly more mixed and less positive than they have been. And kind of then with that technical candle spike higher, then we have seen that big pullback. In the meantime, let's focus on the current huge repricing of Fed rate expectations, really since happening since the October CPI inflation data in the US fell and keeps on falling now, plus that last non-farm payroll miss as well. And then we've had some recent Fed comments really backing the idea that we've seen the last of the hikes now. Market pricing in around or over, I think, 120 basis points of rate cuts for next year. While that may end up being correct, of course, it does leave kind of little room for error in the short term. Problem is that markets kind of create their own reality, don't they? So Fed Chair Powell was widely perceived to have been dovish when he said at the last FOMC press conference that tighter financial conditions were helping to do the Fed's work. But since then, and you can see that from this chart, those conditions, which are basically interpreted broadly to include an array of financial indicators like bond yields, equity valuations, they've now eased substantially. And this chart from Goldman Sachs actually, you can see the index has changed since the beginning of last year, big easing in now in financial conditions, and that's really not what the Fed wants, not what policymakers want, having hiked, of course, by 525 basis points in just over a year. So the fastest, most aggressive policy tightening we've seen in decades. That tightens financial conditions, as I say, but now we've seen this strong, sharp easing in those conditions, which is going against really what they're trying to achieve. In fact, economists actually believe the easing that we've seen is equivalent to just rounded up to around 4 25 basis point cuts just in November, just in 4 weeks. So that's the sort of enormity of what we've been seeing recently. And markets really do overshoot, of course, in both directions. And potentially, we think they're kind of getting too carried away with this rate cut idea. And it's sort of matching, if you remember, we were only in the sort of higher for longer phase just a few weeks ago, a couple of months ago, really. And now we've done a very sharp about turn. So interesting to see what happens going forward from here. I think we should show you of course, the gold chart, which will then you can see better if you've not been following it. I'm sure you have been, of course, but the spike higher in gold that you can see here now. And yeah, that spike up to 2148 is good. If you actually look at, say, the weekly, you can see that spike, and even a monthly, like you can see potentially that's an exceptionally bearish candlestick. Obviously, it's only the start of the month, but you can see the break higher through that sort of resistance around 2060 or so, just above there, 2060, 2070, up to 2148, and then back down to below the sort of previous resistance. So interesting, very much in the sort of early Asian hours. So thin liquidity, and that therefore sharp move price action that we saw. But just we're watching, as I say, those sort of 4 factors, real rates. So that is the opportunity cost for holding basically a yield-free metal, and they've been falling very recently. Real rates, just to reiterate, are the nominal rate, so the normal rate, if you like, 10-year Treasury at 4.19% at the moment. That's the nominal rate minus inflation, and you get real rates, which is, as I say, opportunity cost basically for holding gold. Yeah, so they've come off 50 basis points or so since the October peak. Then we've had the falling dollar, of course, until this week, really. Gold, remember, largely priced in dollars, so though a falling dollar gives non-US gold buyers essentially more purchasing power. Remember, the dollar fell over 3% in November, of course, and then we've had that geopolitical risk hedge, which, of course, gold is a favored asset, safe haven, and a store of value. So yes, just some of those things turning around slightly, and you've seen this fall back of over 6%. We would say probably next support is around 2009 there. You can see that support from the previous highs in October, and we did just dip towards that yesterday, and then sort of found some buyers, popped up to 2035, but we're back to 2021 again now. So interesting whether that will hold as some support or not, and we roll over again. You can see prices were very overbought, of course, in the near term on the chart there. Let's move to stocks now. next, and just looking at the S&P 500. Yeah, really interesting. Obviously, US stocks certainly sitting on really hefty gains for this year, and really now we're all eyeing up factors that could sway stocks in the last few weeks of this year. That includes, of course, so-called Santa Claus rally potentially, and then tax loss selling, where the big names which have done well, big stocks, are sold due to tax reasons in the US before then being bought back. Key catalysts for stocks, of course, will be the expected trajectory for the Fed's monetary policy. Of course, we get non-farm payroll this week, and then after that we get US CPI. Let's not forget the day before the Fed next week. So a big few days coming up for sure, and seeing whether these rate cuts are too much or not, of course. Evidence of cooling in economic growth have, of course, fueled all those bets around that cutting of rates in the first half of 2024. But the S&P is up around 18%, 18% that is, this year alone. And even that Friday high was actually a closing high for the year. Same time, seasonal trends really, they are interesting for this time of year. November and December traditionally seen as decent months for the S&P 500, and of course it gained 9% in November, which is historically, as I say, strong month for the index. December then is the second best month historically for the S&P 500, average up around 1.5% or so, and it's also the month most likely to post a gain, actually, with the index rising 70% of the time. So interesting really after these consecutive weeks of gains. And I don't know why that is there. Let me just take that out. But yes, this big rebound higher, where we dropped over 10% and then rebounded 10%. Has the Santa Claus rally come too soon? Of course, we'll probably get into that next week. That's our final webinar of the year. But the Santa Claus rally is actually between Christmas and then those days between Christmas and New Year, and then a couple of days after New Year. That's strictly the Santa Claus rally, so not really generally December, as it were. Interestingly, I think there's some research saying the second half of December tends to outshine the first part, which really goes with what I've just said. S&P's gained 1.4% in the second half, compared with 0.1% in the first half. So we shall see, but technically, you can see those consecutive weeks of gains, as I say, up towards the July highs, 46.07. Then we go back to the March high at 46.37, before then the January high at 48.18. If we just go to the daily, actually, you can see we're overbought on the daily, not so much on the weekly, but overbought on the daily. You can see that Friday close, the close being the strongest of the year. I think that's correct. If we just pull out, yeah, pretty much looks so. Looks as though that is the case. But yes, 46.07 capping the upside so far. We're sort of consolidating, which potentially looks like bullish consolidation, although we are overbought. So whether we track around here, support, initial support, probably 45.37. Before then, you saw that upside break, so possibly then we go back to around 4,500 or so. That's the S&P 500. Nasdaq rolled over as well, but sort of bid buyers stepped in yesterday. You can see that high from back in July at 15,932. We're just below there now. Just pull it back, then you've got the all-time highs, I believe, back in November 2021 at 16,764. So we're below those at the moment. We're also just below that 15,932 July high. And then you've probably got this high from September at 15,618 as well. I've got some fib levels in here of this big move higher. And there's probably one around 15,600, probably around that September high. If you a minor fib level, actually. In fact, let's just put it in. So to be the 23.6. Yeah, 15,668, so a bit higher than the 15,600 and a touch higher than the 15,618 September high. So that's the Nasdaq. The Dow, really huge move. You can see. Let's just pull out to where we are currently. Probably best to draw a fib level in there at some point, but you can see we've just taken out that July high at 35,679, and then the high from January, the yearly high 36,952. Really strong few weeks, closing near the highs or on the highs, and then pushing much higher. We're not overbought on the weekly. We are on the daily, very much so. So just look for support around this August high at 35,679. Okay, moving on now, we'll just check out first of all just last week's data. Hopefully that's proved of some use to you, just that theme around these rate cuts and then this easing in financial conditions, probably potentially being too much and certainly boosting risky assets, because of course they like a lot of liquidity, and we've seen that certainly, we think, in other assets, growth stocks. Bitcoin, of course, is rallying strongly above 44,000 as well, and you've had some of those sort of riskier funds like Cathie Wood's ARK fund doing exceptionally well. I think the best few weeks it's had in 5 years or so. So just showing you how much liquidity there is potentially around, or and potentially what that means going forward with these easier conditions, which is not what the Fed wants going into that meeting next week. Okay, let's move on to Eurozone inflation. Key number for euro and of course euro dollar, which we'll look at shortly. But yeah, inflation declined more than expected, and really hinted by the early country releases, declined by 0.5% month on month versus consensus 0.2%. That translates in a yearly growth of just 2.4% now. So below the market expectation of 2.9%, well below that October reading of 4.3%. Core inflation, which is certainly what the ECB look at, that also missed estimates at 3.6%. So below the 3.9 expected and the prior 4.2. So really a big jump or big slide in core inflation as well. Was broad-based really, this move down. The momentum, of course, it is slow, which is important for the ECB. Should point out that the previous base effects that have driven these numbers down will now fade, and therefore the low monthly price momentum is what will bring inflation to the target. Really a positive print for the ECB, clearly. They're done on rate hikes, but certainly then as well, these easy financial conditions do open up the discussion to ending the bond buying program, the PEP reinvestments, known as in the ECB, the emergency bond buying program. Potentially that will be discussed at his upcoming meeting next week, which is what President Lagarde has hinted at earlier. Those are the numbers. We've had lots of ECB comments this week, certainly, and also last week we heard from the Bank of France governor, who said that barring shocks, the ECB tightening cycle was over. The ECB would consider the question of easing in 2024. And then I think really instructive has been comments from some of the headline hardline hawks. Really, if we just get to that, you can just see these falling prices. The headline, the lighter line, and then the core still elevated, but falling now below 4%, of course. Just let's check out euro dollar now as well, which you can see just here. Yeah, I'm just checking. You can see that. I should say as well that if you do have any questions along the way, anything you want to look at, or any questions about what I'm talking about, of course, please do ask them along the way. We'll try and answer those as we get them. But yes, just looking at euro dollar now, as I mentioned, we've had some really significant comments for us from some of these hawkish members of the ECB, kind of changing their tune now, saying that rate hikes are now done as well. similar to the Bank of France governor, and discussion should turn to cuts. I think one of the German officials, very much known as a hawk, also said about the fact that she was impressed with core inflation falling much sharper than she had expected, and that was obviously an encouraging sign. One more rate hike is really probably not necessary now. So really interesting and key comments from the hawkish side of the ECB, matching up with the other comments that we've heard as well. That's hit euro, the euro course. Some of the crosses really have gone lower. Euro Aussie, Euro Swiss. If I just pull up some of those just to show you, we don't normally look at those, but you can see the fall there. Although we just bounced back on that Australian disappointment really with some of the data and the RBA meeting, of course. If we look at Euro Swiss, for example, a great example there, 3 really sharp days of selling. And you can just see now we're at key support for Euro Swiss. Some of you might not trade this. It's an interesting pair, of course, similarly matched, but some of the technicals can be really instructive. And if you just look here, I'm just going back to the monthly now, we're on key support. Can't stress that enough. And potentially we should bounce around this level. But interestingly, if we do roll over, then yeah, very interesting levels here. But back to the euro dollar actually, because that is, of course, the most popular traded currency pair. You can see, yeah, break of that descending channel, nice ascending channel, and then we're just breaking down now through that. And you can see we're through the 200-day moving average, which is that black line at 108.20, and we're just above now the grey line, which is the 100-day moving average at 107.70, plus that sort of fib level there at 107.64. So yeah, interesting. If we do move down, then potentially that's the 50-day moving average, the blue line there, that's a 106.95. Of course, much to contend with in the next few days, and we'll get to that very soon. Obviously, I'm referring to less so euro data and, of course, non-farm payrolls than the US CPI, the Fed, and then, of course, the ECB meeting as well. Just moving on now to the RBNZ, another few couple of central banks to look at. It's had unchanged policy, of course, last week. That's 6 months in a row now. It's kept policy unchanged, steady at 5.5% now. But the meeting did have a surprise hawkish bias to it, and that's why we're highlighting it. Really, policy hike was discussed, but in the end, the committee agreed that it was appropriate to wait for further information to observe the speed and extent of easing incapacity pressures in the economy, with rates already currently restrictive and remaining restrictive for a sustained period of time. Some members did add that there should be a low tolerance for any increase in the time to return inflation to target. And also then in another hawkish tilt, the RBNZ, they published their projections, and they had a higher peak rate for next year, and then a slower start to rate cuts and a higher rate at the end of the policy horizon. Interesting, we're just highlighting this because they've been pretty much at the forefront of central banks, and certainly then if you look at the RBA, Bank of Canada today, then potentially you can learn sort of lessons from that. Just before we get to the RBA actually, which is obviously their meeting on Tuesday, which you know, sort of matches in a way what I've sort of said for the RBNZ. But yes, let's just look at Kiwi dollar. You can see the base formed around 58, 57.74, the low there, and then yeah, we pushed nicely higher. It's really a sort of nice ascending channel, really, as much down to sort of dollar weakness as the Kiwi doing better, with the hawkish tilt from the RBNZ, of course, and then with sentiment generally, of course, being more improved. Just on the technical side, then you can see we got up to the fib level 61.8 of this decline at 61.67, just capped sort of resistance with that high at 62.22. Interesting whether we do roll over here or that's just a retracement before another push higher, up to potentially what targets at 62.73 probably. And then you can see the high above 64. If we do roll over, yeah, you've got the 200-day moving average at 60.88, and then the halfway point of this summer moves at 60.92. Should offer some support there in a nice little zone. Okay, next up is the RBA. Let's just briefly just show you a nice chart, which I can get to here. Just bear with me one sec. Yeah, this is just the chart showing you inflation, quarterly inflation this is, and obviously where rates are currently. The RBA left them unchanged at that 4.35%, but sounded less hawkish than expected. And that did see a tumble in Aussie dollar. The new governor, of course, Bullock, had previously stood out as a hawk and claimed, but now claimed that some time is necessary to address the impact of rate hikes, and that whether more tightening is needed will depend on the data. Remember that the RBA had raised the policy rate by 25 basis points last month after a 4-month pause, as progress in bringing inflation to target was developing slower than forecast. That's what they said then. This time, while markets were positioned for a more hawkish statement after the minutes, the SOMP, and given the fact that there is quite an unusually long gap until the next policy meeting in Australia, 6th of February that is. Remember, they're monthly meetings more often than the other major central banks, but there is that slight gap. That said, of course, as well, if you're trading the Aussie, the quarterly CPI data, because a lot of store was put upon the monthly CPI data falling, but the quarterly, which is probably more important for RBA policymakers, that is out next report end of January, 31st of January, I think. So there'll be all outs for that, and watching that will be a key focus before that first meeting of the year, which is not till the 6th of February, the RBA. Basically, they now indicated that new information it had received since the meeting had been broadly in line with expectations. Further decline in goods inflation, services inflation kind of remained uncertain. Wage growth picked up, but the RBA didn't expect to see it increase much further. It's basically biding its time. It's waiting for the impact of those tightening, the rate hikes to feed into the economy some more. So for now, a data-dependent approach, but for us going forward, the door is probably slightly more open for hikes than other central banks. And certainly we've had this recent history of sort of quite quick reactiveness by the RBA to any upside surprises in inflation. And that would probably, or should probably in our eyes, see markets still price in possibly residual bets on rate hikes early in 2024 and give an underlying bid to the Aussie. If we just look at the Aussie dollar chart, which is here, similar pattern to the Kiwi, of course, nice up move, but just a couple of down moves now. We did have GDP data out, softer than expected, 0.2, I think it's 0.4 expected. Aussie GDP out overnight, so just had a fall. But then, and especially on the RBA, you can see that down below the 200-day moving average at 65.76, plus that halfway point at 65.84. So that is potential support resistance. Then moving lower, we see probably support around 65.10. You can see there. And then you've got the 100-day moving average just below that, 64.68. That's the Aussie dollar. But much, of course, now depending on that dollar leg, if you like. Okay, moving on to today, we have the Bank of Canada meeting, which we'll address firstly, actually, just before we get to non-farm and some of that US data we've had this week, jobs data, all important, of course, for markets in the US. Bank of Canada, if we just pull up the chart, first of all, yeah, what's expected? Well, again, they will keep rates unchanged, but and really interesting, it's now sort of slightly, Governor Macklem, I should say, recently said really that rates might now be restrictive enough, and this has helped support expectations that the central bank has concluded its hiking cycle. Interest rates kind of in this 5% range where we currently are do act as a significant headwind to growth, and that really is desirable for the Bank of Canada that seeks obviously to cool inflation, but obviously then they don't want to see too much of a drag to be sustained in the year ahead. Data since the last meeting, that softens. The job market still relatively strong, but has shown evidence of some cooling. The unemployment rate trending higher and wage pressures topping out, while inflation continued to slow, and this is seen as continuing. Interesting, I think, does the Bank of Canada then still hold on to its slightly hawkish tilt due to small risks to the disinflation outlook, or and especially because of this dovish repricing we've seen in Fed rate cut expectations and potentially the growth outlook in Canada deteriorating? Does that mean we get tweaks to the statement? Remember, it is only a statement only meeting, statement only release. There is no press conference, so possibly, probably not, but just then we all have to watch out for the wording in the statement and whether there are any less hawkish messages, if you like. They may possibly emphasize, instead of one more hike, then just a higher for longer sort of stance. But yes, interesting. Always find the Bank of Canada meetings interesting and sometimes offering surprises. Markets looking for around 100 basis points of rate cuts, a bit more now actually, I think, beginning in Q2. The Canadian economy, of course, it follows the US, but probably the US, due to sort of lower household debt levels, locked in long-term mortgages, probably better able to withstand those higher interest rates than possibly the Canadian dollar or the Canadian economy. As for dollar CAD, you can see downtrend and then found support at the halfway point of this summer move, 134.95 that is, and then you've got the 200-day moving average at 135.15. So we found support there, bumping up against this fib level at 135.90. Whether we can push above there, then we get up to the 50-day moving average of 136.87. Otherwise, yeah, interesting point for dollar CAD, of course. Okay, let's move on to now the key event of this week, which is, of course, non-farm payrolls. I'm just going to get, just bear with me 1 second. I'm just going to get towards first of all, the graphic that we like to show you, which I'm just making sure is the right one, which you can see here. So hopefully these prove of use, these graphics. They are for us because they just give you the key numbers that you need to look out for, really. So I think analyst expectations around the 175 mark for the headline. That is an acceleration from the previous 150 added in October, but would still be cooler than the recent averages. The 3-month average I've put here and the 6-month average around just above 200,000 or so. The first half 2023 average 257, and that compares with last year's average of near 400,000. So you can see cooling in the job gains. Unemployment rate is expected to remain unchanged at 3.9%. I've got the Fed projections in there. They were in September, of course, so they will be updated next week, but at the moment they see the year closing out at 3.8% and then next year at 4.1%. But as I say, those will be revised, in the summary of economic projections out next week, of course. Wage growth, that's seen at 0.3%, up for a tenth from 0.2%. Yes, really, I think economists saying the tick up in jobs growth will be really a function of the impact of the strike. If you remember that strike, the United Auto Workers strike in October, the car workers strike. So that's really the impact rather than any resurgence in the labour market. And that would be in keeping with other reports like the Fed's recent Beige Book, which noted that demand for labour continued to ease. Subdued wages, really, that should reaffirm the market's view that inflation pressures from the job market are cooling. so that'll be a focus. Obviously, those softening price pressures and relatively steady growth have boosted stocks that we've talked about, and of course that Goldilocks environment, if you like, of not too hot, not too cold, so slowing price pressures, but then that not having a major impact on activity and growth. It's this soft landing again, if you like. Certainly we probably need to see a really big headline number to undercut those rate cut bets and halt really the risk rally, which is overbought though. So interesting whether that is a catalyst. Otherwise, a weak number will spark fears the economy possibly is rolling over. And that finally, of course, those 525 basis points of rate hikes really are starting to impact, and that may also potentially dull risk appetite. We shall see. A consensus number, well, that probably underpins support for the current rate cut narrative and is possibly a mild dollar negative. We do have, those rate cuts in there. I've showed you, well, I can show you, but around 60% chance of the first rate cut coming in March. And then over 120 basis points of cuts expected for next year. So that's where we are currently. If we just we'll just go to the DXY chart to finish up, which is here. There has been that other sort of jobs opening data I said, which was slowed more than expected. In fact, the ratio of job openings to unemployed workers dropped to the lowest level since August 2021. So that all suggests that labour markets have continued to cool. That's the important takeaway really from that data. Supports again that case for a soft landing as really labour markets are becoming better balanced. So without then clear signs of a growth slowdown. We do get the ADP number out today as well, but that's really not a great predictor of the NFP headline number. Although if we do get an outsized number, that can impact markets. We get weekly initial jobless claims, of course, on Thursday, before then non-farms on Friday. DXY, just to check this out, of course, you can see the 200-day moving average at 103.56, along with the halfway point of the rally at 103.46 as well, pushing up a bit against there. This week's been all green actually, so potentially next resistance level 104.48 I think it is, and then that tallies with the 100-day moving average 104.45. Okay, we will wrap it up there. Hopefully that's proved of use to you guys. I'm just checking if we have any questions. No questions at the moment, so really appreciate you coming on call and spending some time listening to us. Hopefully, as I say, proved of use to you. A lot going on today and Friday, of course, ahead of then those big central bank meetings next week, the Fed, ECB, as well as the US CPI. We do have, we're not bi-weekly actually, so our last webinar of the week is actually next week. So we will preview the Fed for you and the ECB, and we'll have had the US CPI data, so we'll review that and then potentially its impact on obviously the dollar, and we'll look at a load of the crosses as well. Okay, yes, great to have you on the call, and we will speak to you very soon. Take care.